The Wealth Tax Act of 1957, enacted by the Indian Parliament, imposed a tax on the net wealth of specific individuals, Hindu undivided families, HUFs, and corporations. The legislation came into effect on April 1, 1957, and remained in force until April 1, 2016, when it was repealed and replaced by a surcharge on high-income earners. The act applied uniformly across India, encompassing all states and union territories, with certain adjustments for specific regions. Its primary objective was to promote equitable taxation by taxing the wealth of the affluent, discouraging asset hoarding, and contributing to the reduction of income disparities between the wealthy and the impoverished. The tax was levied on the net value of specific assets, calculated after deducting liabilities, as of March 31st of each year, known as the valuation date. The tax was directed at individuals, HUFs, and domestic companies, while exempting trusts, political parties, mutual funds, and certain non-profit organizations. The calculation of net wealth was based on the cost or fair market value of assets, adhering to specific regulations. The evaluation and assessment procedures were comparable to those outlined in the Income Tax Act of 1961. Initially, the tax rate was set at 0.25% on net wealth exceeding 50 Indian rupees lakh. Over time, the threshold and rates underwent modifications, such as increasing to 1% on wealth exceeding 30 Indian rupees lakh. Assets utilized for public purposes and those owned by charitable trusts were fully exempted. The management and implementation of the wealth tax were entrusted to the Central Board of Direct Taxes, CBDT, while income tax officers were responsible for its execution. Ultimately, in the Union Budget of 2016, the wealth tax was discontinued. In its stead, a 2% surcharge was introduced for individuals whose annual taxable income exceeded 1 Indian rupee crore, thereby shifting the focus from taxing wealth directly to taxing high income.